We're about in the middle of the second quarter earnings season. It kicked off with investors processing profit reports from the financial sector, as usual. Our research director, Shiraz Mian, here now to fill us in on how that went and more. Shiraz, looks like some of the bank earnings were better than expected, correct?
That's correct. Yeah. There was a lot of anxiety, Terry, about all the regional bank issues and deposits and things like that. And then there is these macro worries. So all in all, bank earnings turned out to be much better than what everybody feared.
Otherwise, it seems like it's been a mixed bag of news. Of note, you had Netflix earnings negative on a revenue hit. Tesla, another negative standout after reporting a drop in second quarter gross margins to a 4-year low. But on the flip side, just to mention a few, Johnson & Johnson, Travelers, for example, posted good news. GM boosted their profit guidance.
That's right. Yeah, I think that's an accurate description of the results, Terry. Though the takeaway has to be that contrary to all of the fears and the bearish commentary that and this has been ongoing for the last couple of quarters, that we were on the cusp of this significant fall off in earnings outlook and earnings results, and this is another now reporting cycle when those fears don't come true. In fact, a number of companies, mission critical companies, more tied to the health of the U.S. and the global economy, have been talking up the outlook for their business and talking up the outlook for the economy, for consumers, for households, like the ones you mentioned. I would just add to that Caterpillar, which came out with very strong results this morning. So you're right, it's a mixed bag, but on the whole, it's better than expected.
Okay, and this morning is August the 1st for people following on the calendar. So what is your scorecard looking like right now?
So we are quite further along in the reporting cycle by now, Terry. So including all the results that came out this morning, we now have 58.6% of the S&P 500 companies have reported results. 80.9% of these companies are beating EPS estimates. 65.9% are beating revenue estimates. Earnings on a year-over-year basis are down 9%. Revenues on a year-over-year basis are up 0.4%. So goes back to your mixed bag description of the results. But on the whole, a much stronger and bigger proportion of companies beating earnings estimates.
Yeah, you said 80% of the companies that have reported have exceeded expectations, right? Did I hear that right?
That's correct. Yeah, 80.9% is almost 81%.
Is that in line?
So it's much better than what we were expecting. In fact, you would recall that in my earnings commentary ahead of the start of this earnings season, I was noting that estimates for Q2 had not fallen as much as had been the norm in recent quarters. So when you combine the two, that estimates had not fallen as much, and then companies are still beating by a proportion that's above average, that's significant. In fact, the 80.9% EPS beats percentage is the highest we have seen for these 293 index members in the preceding 20 quarters, 5 years. So a pretty notable outperformance.
Is there anything major offsetting those positive surprises so far?
So there's always stuff like that, Terry. The immediate one would be that we are not seeing a corresponding outperformance on the revenue side. The revenue beats percentage in Q2 is tracking below what we saw for this group of companies over the last few quarters. It's not the lowest, but it's still below the average. So there is that disconnect between EPS beats percentages and revenue beats percentages, and then, like we discussed earlier, those macro worries, which is keeping management teams a bit tentative as they discuss the outlook and the trends for the back half of the year.
Tech stocks have been a standout market performer so far this year. How have the big tech earnings come in?
So they have been stronger than expected. You did mention Netflix earlier, and Tesla, and some of the others. Like, the market wasn't particularly impressed with the Microsoft results as well, even though results were pretty good. But then on the other side, Alphabet, the Google parent, Meta, the Facebook parent, had very strong results. We have Amazon and Apple on deck to report results still, but on the whole, whether from the big tech or the regular tech, results have turned out to be better than expected. And the commentary from management teams has also been notably positive to neutral, unlike the last few quarters, with a number of business trends appearing to have started stabilizing. And that kind of goes in line with what you mentioned, how the stocks have been enjoying a lot more positive follow through in the market than other sectors.
Yeah, Apple and Amazon earnings come out Thursday, August the 3rd, for people who are out there and want to know. So, bottom line, overall, do you see strength in Q2 corporate earnings?
Yes. So the expectation, Terry, was that Q2 turns out to be, in terms of the growth rates as well as the aggregate total dollar earnings, turns out to be the plateau, the bottom. And that expectation is getting confirmed. There is a notable optimism about the back half of the year and then 2024. And when you look at that in the context of all of those macro worries, recession and all of that, you just don't see that in corporate results. And earnings and interest rates are what drives the stock market in the end. And this positive picture on the earnings front really provides a reassuring view of why stocks have moved up this year and why that momentum can continue through the remainder of the year as well.
All right. Want to remind everybody that you can always see Shiraz's written earnings commentary, accessing it from the homepage at Zacks.com. And with Shiraz, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.